Let's go.
So that's the Alexandra Mexi clap. Very piercing.
TM.
But it's the 29th of February.
Oh, yes.
It's Leap Day. So we're going at Horizon on the Leap Day. So what have we been up to? Alexandra, what have you been up to since we last spoke? What have you been doing?
Oh, since the last Horizon Unpacked, right?
Yeah, well, actually, we did an episode in between, didn't we? We did Fraser Group and
yes,
Understanding.
yes,
But anyway,
since
since we last spoke, what have you been up to? What have you been doing?
I've been working on our newsletter because we would like to let our listeners know that we are having a newsletter on the way. It's going to be on LinkedIn.
Mm-hmm.
Hopefully today or tomorrow I'm going to make the first post. Apart from that, I'm working in our social medias. I'm creating some interesting and funny video content.
Excellent. Just what we're aiming for.
Funny content.
Video content to
Is that funny haha or funny strange?
It's funny haha, not funny strange.
Okay.
What else? There have been some law firms that I attend with you guys. It was...
the EU emissions trading scheme presentations. They were good, weren't they, do you think?
Exactly.
They were very informative. Very informative. It could be... I think it's going to be an interesting...
I think it's one for a podcast, actually, because what strikes me when we go to these is, one, the audience is really interesting.
Yep.
You know, because obviously you've got the law firms. So we've been to a Reed Smith one and
Hill Dickinson.
We're both very, very good. Really, really informative. But it's the audience, really. So obviously you have ship owners, you've got ship charterers, and there's a lot of kind of concern over... how this scheme is going to work, and it's quite imminent, isn't it? April, I think it's coming into enforcement. Well, it started on end of 1st of January, I think.
It
already.
did, and I think we'll get at some of the details wrong. It's not really our wheelhouse of expertise, but what was interesting is you have to all these carbon emissions that you make throughout the year. You have to record and offset against, and then you have to file.
Offsetting,
buy.
You've got to buy these
things, and then you have to put them in next April. No, I think you have to register them by next April, then to deliver them by next September. But as they were saying, the price of this thing can wing all over the place.
Well, you've got two different markets, and you've got EU and UK, and they're different prices, although they seem to be harmonising, converging. But you've got auction processes for people purchasing. I'm struck by the fact that, from bird's eye view, everyone seems to be kind of one way.
Yep.
I.e., if I was sat there trading these things, and of course you can have brokers and traders providing liquidity, and you probably rely on that. Chances are, whoever's ringing you up, you probably know which way they're going to be. So I think there's a lot of challenges there. That's why I think it would be good for a podcast, and I think we need to get a bit into that because I think what we're noticing is that the banks are increasingly getting back involved in commodities and related activity, and obviously shipping is a big part of commodities. So anyway, well worth it. And then we've been to stuff on Collier Bristow, was good. Non-financial risk, they're really leading the charge there, and on consumer duty as well. Which is I think a really interesting topics. And then the other thing is there's been a lot of chatter about the FCA's consultation on their new approach to enforcement investigations. And that's really got people, I think, agitated a little bit about it. But I think it just underlines, the whole thing really is that there seems to be a bit of a sea change going on at the FCA.
Yes, and I think this did come up slightly in the Collier Bristow, I think in the Q&A at the end, because they talked in detail about this and about the non-financial risks. And someone quite rightly said, how does that work from a staffing perspective? Because they seem to be pushing hard into a lot of directions. And don't get me wrong, we want regulators to be strong and enforcing as much as possible. But actually, you do need the manpower to be able to do this. And to be fair to Collier Bristow, they were like, it's something that we're aware of as well. But it's good that they are doing these sort of things. This recent thing you've just been talking about, the enforcement case, I mean, it is still just a consultation. So the expectation is that you throw it out there and get people to respond. And I'm sure there is a way you can actually put an official response rather than just a post on LinkedIn.
I think a lot of the posts that I've seen have been quite kind of nervy and negative and highlighting, valid risks. But I think I think there are some positives, as we're involved in investigations, and I think where we have found, over the years, it can be very hard to get an understanding, even with all of our subject matter expertise. It can still be a challenge to get into things, and it's a hell of a lot easier when your understanding is massively expanded by someone on the inside, effectively a whistleblower. Someone comes forward, but of course the chances of them coming forward is quite slim when you put such kind of silence around an investigation, and there's legitimate reasons for doing that. But actually, there is a lot of benefits I can see in that too. So I'm pretty interested in this consultation. I think we will be contributing to that definitely from a kind of subject matter expertise point of view. So anyway, what we really are here for is Horizon, and we've got some pretty juicy topics this month, Damian. What we're going to be looking at, we're seeing a lot of activity in the CLO market. Which kind of continues this theme that we've been sort of talking about since the end of last year, really. Credit default swaps, the credit market, and all of these kind of products that were, big before the global financial crisis and kind of fell out of love. They're all kind of coming back, and I guess it makes old timers a little bit nervous, but also it's kind of interesting just sort of seeing, which way, the market is going on some of these things. I think what we're interested in is the fact that the equity tranches are being underwritten by lead managers to help kind of get deals away. And that brings, I think that can give us a, good, interesting conversation just about issuance generally. And then you've been focusing a bit on commercial real estate.
Yeah, we've had a lot of headlines on commercial real estate. Towards the end of last year, it seems to be picking up pace a bit this year. A lot of people are increasing provisions quite massively against some of the issues that they're starting to see there. Obviously, the rise in interest rates has caused ructions, and maybe we'd put it that way. Some of the press you read is sort of saying a lot of property people are kind of holding on the hope that the rates come down as far as people were talking about earlier in the year. But it feels like, and actually, I think forward pricing is telling you that they may not be coming down as far as people were thinking, and I think that could be a real problem for some of these loans and some of the window where they'll need to get refinanced. If rates haven't come down by that, then you'll run against cliff edge quite fast. So we could there's some stuff to talk about that.
There is, and all the while, I think what you and I might agree is that if we were trading in this market, certainly I think I would have lost a lot of money, because I can't understand it. You've got things blowing up potentially in commercial real estate. You've got an uncertain political and geopolitical environment out there, as worse as I've known it probably since I was probably age 10. And yet we've got the market screaming ever higher.
Yeah, it's risk on.
It's risk on,
yeah.
And I just, I'm a little bit perplexed on all of that stuff. And then finally, we're gonna talk about just a really revisit and just re-emphasize what we've been saying to people about the risks inherent in all these internal forums and approval forums, and what's really brought that out again to kind of raise our attention on is what we were talking about in the Frasers Group versus Morgan Stanley podcast. So I don't think we'll spend too long on that topic, because there's a whole podcast that people can listen to and enjoy on that one. We did nearly an hour, and I think, Alexander, didn't we?
Yeah, it was
record breaker,
3 minutes.
Yeah, but all, jam-packed. Jam-packed. So, anyway, we better get on, otherwise this episode's going to be 53 minutes. Right, so, well, why don't we kick off with the CLO stuff, because I think we probably can deal with that very quickly. And I think before we dive into the specifics of CLOs, just want to give a kind of bird's eye view to people about, just issuance in general. Doesn't really matter, what the product is. I did a lot of, I was, fortunate enough to do a lot of issuance, particularly when I was in Asia, around private and public issues. And that really gave me a good viewpoint on, the kinds of, what it's like to be underwriting risk in deals, because the perception on deals, and even when you lay them out to the issuance committee, whatever it happens to be, the capital commitment committee, a deal is soft risk, but as soon as it goes live, you're on hard risk.
Yeah.
So this idea that there are only hard risk deals where the bank is on the hook, and it's kind of laid out beforehand. The reality is, as soon as you decide to pull the trigger on a deal, it's very difficult to hand that deal back to the issuer and go, actually, sorry, do you know what? We couldn't get it done.
Yeah.
I have seen that happen. I remember Credit Suisse, I can name because they're no longer. Credit Suisse, I think it was Bumi Resources,
right.
An Indonesian name. They were shot to Bumi. And I'm pretty sure they handed a deal back, shocking the market, but actually setting a kind of new paradigm, really, where they went, live on a deal, couldn't get it done, and went, actually, sorry, shucks, there you go, here's your ticket back. I don't imagine they got any fees, but there you go. So that's the kind of the reality, and of course, then you have bought deals where people are so confident they take the whole issue down and then resell it on to others, and that's great for issuers in the sense that they know that they've absolutely got a ticket done, and they get their proceeds. Of course, they will pay more for that because underwriting has to take into account that risk. You also might be able to make a bit of a turn in terms of buying something at par and selling it on at 101.5 or whatever it happens to be as well. So those are interesting cases in point. If the press that we've read is to be believed, and I know obviously people are running this story in a number of places, then CLOs, collateralized loan obligations, which are these products which you take a pool of loans and then you tranche them out, higher quality in a top tranche, all the way down to an equity tranche, which is the last to get paid.
Yes, and actually you wrote about this in the piece, and this is not really my wheelhouse at all. Equity doesn't mean an equity as I would think of it in this case. It just happens to be the bit that sits at the bottom. So the waterfall comes all the way down, and that's the last bucket, as it were, that gets filled.
It's probably better to think of it as subordinated risk, and the other tranches are more senior to it. So that's I think the best way to think about it. Where there is a kind of quasi ownership, if you like, is that if you're the majority holder of the equity tranche, you have the option to call the whole structure. Right. You can also what's the word? Let's not deal with that. Let's just deal with that particular option to call the whole structure down, and that is because, of course, if you're the equity tranche and you're no longer receiving the proceeds because the asset quality in the loan portfolio is such that none of those proceeds are reaching you, then you can then call the structure and wind the whole thing up.
Right, okay. And you might not actually get anything in that.
Absolutely.
But you might be being priced at zero anyway, so you kind of go, well,
exactly.
Actually, we're going to get.
It's just like, let's just take the whole thing down. Now, you might do what happens is all the underlying portfolio of loans are liquidated, and the money is then returned to everyone in proportion, in order. In that case. So, but what is interesting about that equity option is the equity tranche is usually about 10% of the deal. So you've got control over an awful lot, by owning that. But it is poor, in terms of seniority, or it's really sub, and people don't like that, or customers tend not to like that. Investors don't like that.
But I assume you could. I mean, this thing's trades slightly by appointment, but you could go and hoover up equity at cents to then to force a collapse because. You thought something that was being misvalued in the portfolio.
Well, don't forget that there is. So we're kind of jumping ahead really, but in terms of how a CLO works, CLO life starts even before the origination, because you lend the collateral manager money if you're the bank to go out and build the loan portfolio. So you're actually earning fees already just on that lending. And then when you get to the point where they've built up this portfolio of loans and they're ready to bring the CLO to market and tranche it out, then there are arrangement fees that people can earn too.
Right.
But the problem might be that you cannot raise enough demand for this equity tranche because everyone wants the higher quality tranches. Now, actually, the equity tranches, if everything's going great, that should have by far the biggest yield. So it should be attractive.
Yeah.
But generally, customers, it seems because of people are having to take this action, customers are shying away from those tranches, which is kind of interesting. So you are getting the situation that lead managers are underwriting a portion of the equity charge. Let's not say that they're underwriting the whole lot. It seems to be somewhere around 25% and it's in selected issues. So you're hoping that they're doing their due diligence around this stuff. It tends to be, it seems, with new managers that they're trying to kind of assist and support and bring on, and that all sounds very admirable and very, very good. You have a non-call period because the collateral manager is going to actively manage this portfolio of loans, which they can do, and then they don't want to be under the threat of having the whole thing taken away from under their feet. So they have a big interest in owning the equity tranche because then they can take control of their own destiny, if you like. But the other thing is as well, they will be earning management fees. And of course, that will all be taken away if the whole thing goes. So there's a good reason for them to want to hold the equity tranche. The difficulties, I think, arise potentially where, there's a few things I can kind of foresee in this, thinking about the way issuance works. First things first is, how easy is it for people in the control functions to identify when the business is holding a position because they want to hold that position rather than they've been forced into holding that position?
Yeah.
Because I would argue that it's in everybody's interest to make that as transparent as possible, to management, to people, to the two stakeholders, that the bank has this position and there's a reason for that. So, I've certainly had situations. You and I have managed positions. Remember we back at ING, we ended up with positions,
and they're different books. Where did they sitting on the sort of the back book? Are they sitting on an agency book or wherever it may be to provide liquidity, for example? But
yeah, exactly. So that's the first thing is, how do you identify, and is there a case for putting this stuff on a different book? Mm-hmm. We've mentioned the fees. You've obviously got fee income on the lending. You've got fee income in terms of the arrangement fees. And I was fortunate in that where I tended to work, I had a good share of origination fees, even though I was the trading book, because it was recognised that we supported deals, we took risk, and we got a portion of those fees. Plus, of course, the efforts of the salespeople in terms of placing the deals. And then, of course, the other side of it was the origination by the capital market staff. So, of course, they got a share of the fee. So that worked out quite well. And, you have a possibility, I think, to use those fees rather than recognise them if you have a problematic situation like this, or you have done something to get a deal to go, then you can use those fees to reserve against the position. Right? And I think that should be, that's certainly what I would recommend to people to think about, to consider, because you can then have a situation where, as the position is sold, you release the fees and everyone's good. Because what you don't want to happen, and I think there certainly can be a tendency around this, and we know how issuance tends to ramp up around year end, has a tendency to do that, as people try to achieve calendar, etc., get things closed. You could have the situation where everyone recognises the fee income and the problems are kind of kicked down the road on this stuff. Yeah, you can see that. I think the other thing too is that it's really difficult to price test this stuff because these are, quite specific issues. You might be able to kind of look at comparables, or you should be able to. I think what you should recognise too is that if the lead is taking down a slug of this 25%, and they're probably going to be expected to provide some kind of secondary and follow-on market, then if you are doing the IPV, you're probably, you need to be alert and alive to the fact that you're probably getting, echoing back your own mark from, you go and ask an IDB, or where are these? Well, where have they got that mark from? All that kind of stuff. I mean, that's a problem in many products, but I think something that this particularly highlights that you need to be aware of. And I think that the last thing that really kind of, I don't want to over-egg this to people, but I do think it's something to think about with CLOs in general and the power of the equity tranche. If you have an option which gives you the ability to collapse an entire structure, so you're holding 10%, but you can collapse the 90% and return that money. Yeah. There are a group of people in the market, a very identifiable group of people in the market, who are price insensitive, who do not care if economics works. And of course, I'm talking about money launderers. Yeah. Because for them, any time they legitimize their money, it comes with a cleaning fee. So if you can go out, buy up all tranches in a CLO, and get a majority stake in the equity, and of course a bank desperately trying to shift this under pressure to move this kind of paper might be pretty indiscriminate with who they sell to, because they just want to avoid capital charges, because this stuff is going to be punitive on the capital front. Then there is, I think, the possibility and the risk that this falls into the hands of somebody like that, who could elect to use this as a massive liquidity event to clean a load of cash. Yeah. And we highlight this in our wholesale money laundering, anti-money laundering training, along with a few other, different ways and how to identify, the instruments in the wholesale markets that are most at risk. So that's sort of where I'm kind of, coming at this CLO stuff. I think it's a very interesting situation. I think that, again, markets are very frothy. I would like to sort of see, we've talked about, the fee recognition and the warehousing of risks. I think when you have approval committees, in my experience, you can have approvals committees that kind of approve stuff with a kind of caveat or some kind of restriction. And it's always the case with these kind of approval committees that everyone can agree that, but then you've got to ask yourselves the question, well, how can we monitor that? And I think that's definitely an area of inquiry for auditors looking at this stuff. If auditors haven't put approval committees on their list for this year, then I really think they're going to miss a trick. Because the amount of issuance that's going on in certain products, especially in this market, we've got a market that's really running hard now, and I got to think that CFOs, etc., people are going to be wanting to issue into this market. Yeah. So I think it is an area of risk generally, but certainly how do you keep an eye on that kind of restriction? Also, how do you monitor? Because concentrations are a perennial problem in issuance, i.e. if you get too much in a particular sector, then customers all get full, they can't take any more. And that's always the case, because certain sectors are more hungry for capital than others at times. Real estate, which we're going to talk about, is an absolute example of that. So again, how can they keep an eye on not just what's happening in their own shop, but also outside as well, just to make sure that they're not building up those kind of risks. So that's the CLO stuff. I hope we've done that pretty quickly. Why don't we have a crack into the commercial real estate stuff?
Yeah, sure. So as we sort of mentioned at the beginning, there have been a number of headlines about increased provisioning in this space. And it really is, I suppose, a function of this very quick rate rise that we've seen. So property was able to refinance for years and years with rates kind of bumbling around zero, but now up at 5-ish. And the outlook, which was looking to come down quite significantly by the end of the year and doesn't seem to be so as we sit now, just means that that risk of increase in the actual increase in provisioning, and we'll probably see a fair bit more to come throughout the rest of the year, just could have some quite big knock-on effects. Mostly because real estate sits as a lot of collateral under a lot of loans, possibly in the CLO space. I mean, these two things are slightly interlinked, as you as you said. So we've just been sort of highlighting that to people. I mean, obviously there has been a lot of press about it, and it's just how people look at valuations of these things. And certainly from some of the articles I've read, there seem to be in different jurisdictions have different ways of valuing how this stuff is on their books. So sometimes some of them will only use quarterly, sometimes it'll only be an annual revision to the property value. Some jurisdictions will only use transaction data in it, and some use transaction and sentiment data as well. So obviously you'd expect with sentiment falling, for example, that the marks in that would be commensurately lower. So this was just, the main thing that we've been pushing on, that, control staff should be looking at this area too and be aware of the fact that, how marks are derived, how valuations are set. That's really what we've been pushing out.
I think sort of, experience of what we have seen over the past decade in some of this stuff. So, people to kind of, things to be on your watch for, I think. In any situation where you have an illiquid asset class which has bouts of stress, people lose visibility on pricing. It doesn't really matter what that asset is, but obviously real estate is a kind of a case in point. And the front office, the business, do have the ability to actually point to certain transactions, even if a transaction occurs, because you've pointed out in some jurisdictions, that they're looking at pricing points and transactional data. If this stuff is very illiquid, they can just point to that and go, well, do you know what? That really wasn't an orderly transaction that took place between willing, market participants. Yeah. And so really, you actually don't need to recognise that one. And that may be true actually sometimes, but in other cases, it may not be the case, and it just provides that scope for people to turn around to control staff and go, it's the age-old thing. You don't understand my business. You don't understand my business. I'm on the front line. Let me tell you that mark that you're trying to point to is just irrelevant. It doesn't make sense. Yeah. And also given the size of that versus my position, if I chose to sell this, it would happen at this level or whatever. And so it just leaves the door open to staff being able to interpret, misrepresent, and argue that certain transactions may not be representative, for marking purposes. The other area of risk, I think, around this that we've seen is where, you have comparables and people are reaching for some very questionable comparables to look at stuff, which, as markets become more stressed, the differences between different references, I think, can become greater. I mean, there is an argument for saying all correlations increase in down markets. Even the pretty ones die in the bus crash, all that kind of stuff. But actually, we're not talking about that kind of stuff. We're talking about a market that's becoming stressed, and a shopping mall becomes more different than a hotel. And of course, then you have the shopping mall attached to the hotel and all that kind of stuff. But it becomes, I think, much more important to be a lot more granular around stuff. And then another area which people should be aware of is where, if you have like a joint venture, and that quite often happens. Particularly, you might have a market that is difficult to access as a Western bank. May not be able to get a local license, so you use a local partner. You might give that local partner capital. So they're using your capital to go out and originate stuff, create loans, etc., that's backed by real estate. Now, you are then in a kind of second degree risk. One, you can't really, you don't have direct line of sight as control functions over how that money's being employed. But then also, it may be that joint venture or the stake that's owning that joint venture is held in the books of the bank at a particular level, and it may not be, or it needs to be recognised that any revaluation of that could be quite significant when there's all of this kind of stuff going on in the market. So those are the kind of the risk areas I sort of foresee, or we foresee, with what's going on in CRE as this continues to play out for people. And as you rightly point out, real estate is so important because it backs so much lending, it supports so much lending. So very, very, important. But you'd also think then that people are, quite wise to, some of the potential problems, given that we've had, things going on in Asia for a couple of years now. But it does seem to be kind of going further around the globe now at this point.
Yeah, and actually, as some articles have pointed out, in mitigation, talking about sort of things need to start being marked down. Well, some of them weren't marked up on the way up. So, in fact, the hits to businesses might not be as extreme as they could perceive to be. So, anyway, watch this space. It's definitely. Yeah. And then we'll come on to our third point, which is a sort of slight revisit of the podcast we recorded earlier on in the month, just regarding internal forums and the internal discussions that take place within banks. It's been brought to the fore again this month by the Frasers Group versus Morgan Stanley case. And it just goes to show that communications that take place within banks that are expected to probably not see the light of day may end up seeing the light of day somewhere down the line. So, we talked about it in the past. We talked about it actually as a sort of thing to watch in our last year's piece. Board minutes maybe, and then just general, some lines are recorded within banks. Some things you get that are said there.
I think that's a really good point, Dan, because we're talking about really something. I think if you're auditing culture and conduct, you should be looking at this stuff because you might make the assumption that because we're in a boardroom in London, having this conference call about something, that the minutes are going to carry the evidence of this call.
Yeah.
But I know, as a trader that used to sit there in Hong Kong, I'll probably dial into that conference call from my dealer board. And, you may not realise that actually there is, in fact, a recording of that call. So that's one risk. But I think, fundamentally, what we're trying to get across to people is that you have a situation where there is so much more audit trail now than there was 10, 15 years ago. But also you have so many different ways now that people are becoming alive to accessing information from within institutions in terms of, subject access requests, freedom of information. These are routes now that are getting tested all the time and delivering information. And really it's I think we've said this before, but it's worth reiterating. People are human. They don't like delivering difficult messages to people.
Yeah.
So they may be economical with the truth or actually tell, barefaced white lies around stuff. And that's going to be a problem if later it's uncovered that something else has been said.
Yeah.
But also, I think, in light of some of the cases that have happened, and let's just say in light of some of the personalities out there that have kind of, raised the prospect of this stuff, even if at the particular forum you make a decision and you deliver that decision to the customer, the fact that outside of that forum there's another conversation that's recorded and there's a record between two participants that says something else or a little bit suspect, that can be problematic. So I think it's definitely an area of risk that people need to, tidy up around, or not even tidy up around, actually. I think this stuff needs a really, really good look.
Yeah.
Because, as I say, it's definitely an area of kind of culture and conduct risk that I think is emerging. And I do feel on this one, it's a bit like, we were sort of shouting into the wind on NDAs and non-financial, misconduct. We started shouting about that, 2.5, 3 years ago. And people just went, well, what are you on about? And you move forward three years and now, the FCA is asking people about that.
Yeah.
I feel on this stuff, a little bit like that. You know, we're kind of shouting into the wind on this stuff, but you mark my words on this. And if you are auditing conduct and culture, I think you have to be looking at this, you know, really carefully now, because the debanking story is not going away. You know, there's now sort of, you know, scrutiny around small, medium enterprises, SMEs, and the amount of, you know, accounts that have been removed. And it is looking to be, you know, a bigger and bigger problem. But now we're starting to sort of see this stuff migrate into things that we're talking about, that it's not just a bank account problem. You know, it's other problems. You know, it's just other ways that you have signaled, you know, decisions that affect people from a, you know, capital point of view, investment point of view within the banks. So
you go.
Kind of a bit of a gallop through this month's Horizon DT, Alexandra, but I think, you know, it is jam-packed. It's a good one. If you wanted to read more about any of this stuff, you know, the Skadi Discord is the place.
Yeah,
that is a treasure trove. Join Skadi's chat community, but you can access all of the materials that we use, you know, to put together, you know, to collect our thoughts for Horizon. But also that's right. Yeah, all the podcast stuff. Alexandra, you've got, you know, a jam-packed one on Greece, haven't you?
3 episodes.
I did. I think there were a couple of episodes that they had like they pick up some new listeners. But we have our podcast have like different sections for every episode that we publish, that everyone can go there, see all the source, all the material we use to produce our podcast. Like,
well, didn't you have some? I think you had some students from the.
Oh yeah, it was a French student that he was doing the Greek crisis.
There you go.
Yeah, he was
in there accessing from the horse's mouth all of the materials, help do the dissertation. So it's good. You know, lots of uses, but also, you know, if you are an auditor and you've heard something on here, you want to kind of look into it a little bit further. You know, it's all there in the Skadi Discord. Definitely a treasure trove for people to get involved and also become, you know, a close friend of the show. So there we go. Right, DT. See you in March.
See you in March.
Not in 4 years' time, Alexandra. Okay. All right. Thanks for listening, everyone. Bye bye.
Thank you.